Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Analysis webinar. It is currently roughly 2 p.m. Eastern, Monday, February 12th. Through this webinar, we'll be doing some quick higher time frame review on gold, US dollar, and GBPJPY, just to understand some of the more macro positioning, some intraday technical analysis of key prices in our main bias, CPI prediction and scenarios, other key data in the near term, and then translating that information to trade ideas on gold, GJ, GU, EU, UCAD, and US 30. Now, I just want to start off this webinar by doing some key higher time frame analysis review, looking at gold, dollar, which you can correlate the information from dollar to dollar pairs, and GBP/JPY. Now, of course, gold has the macro base case of bulls starting to develop, but we can understand that we see a lot of difficulty for gold buyers to remain above this historical fundamental price around the deeper 2060s to 2080s. I'm not expecting to see some aggressive gold bearish move back down into the 1200s or trying to call any type of crash or anything of that nature. But what I am anticipating with some of the events that are starting to unfold is a potential bearish corrective leg that could at least come down to even retest into the 1920s and 1940s before we start to anticipate further buys again. Now, we have to understand that we trade these markets through the perspective of day trading or scalping. So whenever we can assess a larger market wave that's going to take place, we have to adapt to it accordingly. With Middle Eastern tensions being priced in, dollar demand starting to come back into the table, and still having relatively resilient US economic data and not seeing major policy lag effects in full force yet, if we have a higher CPI reading this week, as well as other resilient US economic data, and we start to trade below the 2000s and 2010s, then seeing a corrective leg down into the 1920s, 1940s, before we anticipate higher time frame buys again would not be out of the ordinary. This price point digging into the 2080s and 2100s is very important fundamentally, especially with the collection of events we've seen over the last 4 years. Even when we've had a massive surge with gold demand rising, global fear, uncertainty, or doubt, central bank jumping in to do stimulus during the initial pandemic fear, we still were not able to hold and trade above the 2080s price point for a consistent period of time. Even as we had those events priced in and had a new event come to the table, which was, of course, Russia invading Ukraine, also starting to spark some more global fear, uncertainty, or doubt, we still revisited those prices, but failed to really sustain higher for a consistent period of time when we're observing the higher time frame. Even into 2023, when we had the US banking sector failures, the SVB collapse, and of course, Credit Suisse, which followed in the Eurozone, we had enough bullish demand and a beautiful rally from the lower 1700s all the way up into the 2080s here, but did not really sustain higher above those prices. Even when we had the Middle Eastern tensions escalating between what was going on with Israel on the Gaza Strip, and even as we had during that same period of time, rate cut hopes starting to increase, we still have not sustained price above the 2080s for a consistent period of time. So there's clearly a lot of sellers pressure in these higher time frame prices, especially looking at the 2080s. The same time, we're starting to see failure to hold above the 2080s into 2024. We've also had more consistent, resilient US economic data, removing any of the recession risks. We've had the Fed still sticking to a neutral to hawkish tone of keeping rates up higher for longer, even pushing out the hopes of a March rate cut. We haven't had any new escalations of geopolitical tensions to spark demand in gold, especially at these higher time frame prices. And we've started to see dollar demand stabilizing, with dollar respecting intraday and higher time frame bullish structure, which we will look at in a second here. So, in my opinion, again, I'm not expecting to see gold crashing down to historical lows, but if we continue to hold below the general 2040s on the intraday timeframes and also start to trade below the 2015s and 2010s, starting to see bearish corrective legs over the course of the next days, weeks, if not months, to go deeper into the 1940s looks very realistic before starting to anticipate buys from a lower dip demand zone there. And that's just something I want to highlight here. It's also not the best prices to be buying gold at from a historical standpoint if we don't have further catalysts coming in to spark more demand in gold, whether that's fresh, new fear, uncertainty, and doubt from a global perspective, or starting to fuel back into the greedy hopes of more rate cuts, aka needing much lower inflation and weaker other US economic data reporting. Last week, we saw that services sector PMI, other non-manufacturing PMI, was still in an expansionary stage well above the 50 grade point and actually improving. We saw that the US jobs numbers, whether we want to say they're manipulated or not, or there'll be another revision from the Bureau of Labor Statistics, it doesn't matter to us to argue or debate that. What we saw is that the US labor market is still very hot, very healthy, with NFP blowing the forecast out of the water, unemployment rates still being the same at 3.7%, and even seeing a very sharp increase in wages, which also puts upside pressure on inflation and increases the probability that the Feds will keep rates up higher for longer. In my opinion, these key technical pricing points, alongside that fundamental bias, can lead to a very controlled bearish correction over days and weeks down into the 1940s before attempting higher time frame buys again. I would also need a collection of catalysts to even be jumping back into gold buys at these higher time frame prices, meaning my prediction would need to be completely wrong, and we would need to see CPI this week on Tuesday coming out much lower than the 2.9% forecast, heavily feeding into the disinflation narrative in hopes of more earlier rate cuts in 2024, as well as seeing an outflow out of dollar and dollar breaking this intraday bullish structure. So it's difficult for me to even be, from a day trading or scalping perspective, or looking at the current market waves, jumping in strong gold buys, especially if we're still holding below the 2040s there. Right? Even when we're going down into the daily time frame, you can see, looking at current structure, we understand that that 2080s is that key fundamental price where we struggle to remain above, even with major unique fundamental catalysts sparking gold demand, whether it was the COVID pandemic fear, and the massive stimulus that associated with it, whether it was Russia invading Ukraine, whether it was the Middle Eastern tensions, even the Red Sea tensions that sparked and escalated from there, or whether it was rate cut bets, we've still struggled to remain above that price. We're also starting to see a bit more of a price squeeze and bears in control here, just holding this last bit of an intraday support level around 2015s, where after that, it looks like pretty smooth legs down, especially if CPI reading is still higher down to 1980s. I would personally like to see a deeper bearish move and correction on gold correlated to some of the central bank policy positioning signals we'll get, as I don't really want to be buying gold long term at these higher time frame prices. I would much rather prefer some type of pullback and correction to take advantage of first. Right? So we can see the exhaustion by buyers and not having enough order flow above the 2080s. We can see that from the 2060s last week and the previous week, sorry, and those pullbacks we anticipated in that area. We can see some more stronger intraday bearish market structure still being respected. We're just holding this last bit of a support zone roughly around 2010 and 2015, where give or take even some liquidity grabs for CPI, I would still anticipate us trading below and starting to retest into the lower 1980s over the course of days and weeks as some key target points there. Now, this lines up where we're starting to see a bit more exhaustion of buyers from the higher time frame on gold here. Very similar repetition of as these major fundamental bullish events get priced in. We don't have any further new events for the market to price in to add on to that sentiment and narrative that we can start to see a controlled correction. So that's something I'm still keeping an eye on here on gold at the 2080s, potentially looking to see a correction taking place into the 1920s before starting to see deeper into 2024 policy lag effects of rates being up higher for longer, starting to work its way through the economy and starting to see more consistent declines in economic data, which then could spark some more gold demand at these lower prices deeper into 2024, or any new global fear, uncertainty, or doubt, or impacts to the supply and demand sentiment, which we have yet to see there. Otherwise, unless we're breaking back above the 2060s with rate cut bets in full force, I don't see us jumping into buys immediately on the higher time frame perspective. Now, this also lines up where when we're looking at the dollar higher time frame positioning, overall, compared to the bullish rally that we saw, where we first started to see Russia invade Ukraine, sparking more demand in dollar due to its safe haven properties as the world reserve currency, also coupled with the Federal Reserve doing their most aggressive rate hike cycle in history, we had this overall bullish rally through mid-2021 and through the majority of 2022, about 8 months through 2022, which we coined in Capital Hungry as the dollar domination phase. Now, the correction that we saw in 2023 was overall just a 50% correction of this impulsive rally, and it was going to retest previous key higher time frames points here at 102s. This 102 price is an important price here on dollar, where even with rate cut bets that were holding weight through a significant period of the end of 2023 and into this new year, we still haven't seen us fade out a 50% correction of the bullish move and still haven't seen us trade below here. This doesn't mean I'm expecting dollar to surge back into the aggressive rate hike cycle prices of 2022, but what dollar can easily do is create a higher time frame consolidation at these elevated prices, especially if we still see US economic data remaining resilient and inflation still troublesome and not trending cleanly towards the Fed's goals back into this historical sticky zone, showing that rates need to remain up higher for longer. We could easily see dollar retesting back into the 106s, 105s, even into the 107s. So from a technical perspective, when you're zooming in here and looking at the daily, one, the overall bullish rally and global demand on dollar that surged with the aggressive rate hike cycle has not been faded out. This was only a 50% correction. Two, we're holding that very key price zone and demand zone at 102s. Three, it looks like we're going to be retesting as long as dollar demand holds steady. We don't have any weaker economic data this week or dovish Fed speak. And especially if we don't get the lower inflation, if dollar's still holding above 103.5s or breaking above the current intraday prices, potential to go back into the 106s still looks very evident in my opinion. The same time, we're starting to see gold sellers exhaust from those higher time frame fundamental prices in the 2080s as rate cut bets are starting to get pushed back further, is the same time we're starting to see dollar buyers accumulate from this lower demand zone at the 102s, where we had a shift out of that bearish structure and more bullish structure starting to be created that we've been playing for the last couple of weeks so far, especially with the support of a more hawkish, neutral toned FOMC as Jay Powell completely pushed out the hopes of March rate cuts. especially as we're seeing that majority of PMI data is still above the expansionary point and above the 50 grade point, removing any chances of recession scares and also putting upside pressure on inflation, especially as the US labor market is still very tight, still very healthy when we're looking at JOLTS job openings, the general range of jobless claims data, and the last non-farm payrolls report we had in unemployment rate. To me, we're not seeing policy lag effects in full force yet. The US economy is remaining resilient amidst these tighter financial conditions, and it still shows that the Federal Reserve needs to stick to their guns of keeping rates up higher for longer and making sure they don't repeat the mistake that the Feds made in the 1970s of pivoting too early. So from a higher time frame perspective, it looks like gold, if we don't trade above the 2080s and 2060s, if we don't have any new fear, uncertainty, or doubt catalysts, if we don't have that lower inflation report feeding into rate cut bets and earlier and more rate cuts through 2024, it looks like gold can be giving us deeper corrections into the lower 1900s, and dollar could be seeing further bullish upside into the 106s here. Now, when you're looking at the dollar price positioning and understanding its position as the world reserve currency and how it dominates whatever currency pair it's in, right? If we see that continued dollar bullish upside digging to the 106s, then when you're looking at pairs like Euro USD on the higher time frame, it's not surprising why we're still just seeing more of the inverse of that move. Overall bearish leg down during the dollar domination phase, pullback phase, that's a 50% correction, major key supply zone being respected, still potential ranges to play back to this zone low into the 1.06s. You're going to see GBP USD is very similar structure to that, while USD CAD is the inverse. So in my opinion, the higher time frame technical structure, the higher time frame pricing on gold, on dollar pairs, is still showing me that institutions are positioned to push back some of the rate cut hopes, price in rates being up higher for longer, specifically when we're looking at gold and some of these currencies going against the dollar. Right? Last but not least, what I wanted to check out on the higher time frame is GBPJPY price positioning. All of you have probably heard this in Capital Hungry so many times, but I still see us going back up to pre-Brexit crisis prices. We're seeing a very similar technical repetition where after we had the 2008 global financial crisis, you can see we had this very clean bullish rally all the way up to the 195s before we had an individual negative catalyst impacting British pound demand, which was, of course, Brexit, right? Brexit has been solved. That's all been handled. And what we've been playing since then is the interest rate differential of the Bank of Japan sticking to an ultra loose policy, keeping stimulus active, as they are still not satisfied with inflation figures and economic activity. And while on the other hand, the Bank of England is doing the opposite of combating and bringing down inflation, keeping interest rates up higher for longer. That interest rate differential is the main reason we saw GBP/JPY so bullish ever since the pandemic impact got priced in here, which just looks like a blip in the general macro image of things. And to me, GJ still looks like over the course of the next weeks and months, we can go back to these prices of 195s before starting to look for higher time frame sells based on the price positioning. And by then, deeper into 2024, weeks and months from now, that's when I expect to see the Bank of Japan start to sprinkle policy tweaking signals. That's when I expect to see UK inflation further cooling and Bank of England starting to talk about rate cuts. And we get that interest rate differential started to get flipped on its head with what the market anticipates of these pivots. Bank of Japan pivoting from an ultra loose policy to coming out of negative interest rates and starting to raise rates. Bank of England's going from a rate hike cycle to starting to talk about rate cuts and the market pricing that in. Overall, I still see GJ bulls for the time being up into the 195s. We still have beautiful bullish market structure and bullish price action, repeating the chain of events we saw during that run after the 2008 global financial crisis. We can see a bunch of liquidity that's been accumulated from that 180s demand zone. We had a very strong monthly bullish candle close. We had Bank of Japan Uchida last week further cement the ultra loose policy. We know UK inflation is still troublesome. In the last Bank of England rate decision, they're focusing on keeping rates up higher for longer. In my opinion, GJ still has very solid ranges to be swing trading or day trading, playing it week after week, give or take some intraday pullbacks into the deeper 190s here. Looking at the 195s and 196s, which is still more than a 600 to 700 pip run from current prices. Right? So just wanted to do that bit of a quick higher time frame review on gold, US dollar individually, which you can translate to dollar pairs, and of course, GBPJPY. Now, the main meat and potatoes this week, the main signal that the market is looking for in terms of Fed policy positioning, whether we take away from rate cut bets and push them further back, or support rates up higher for longer, or whether we see the market getting some more greedy, anticipating more rate cuts, is going to be dependent on the inflation outcome. This week's inflation data is looking very interesting. There's actually forecasted expectations that inflation is going to be dropping from a previous 3.4% reading all the way to 2.9% on the headline year-over-year data. I personally think that we're still going to see elevated inflation. That's my main bias and prediction. I still personally think that inflation can be above 3% and above the forecast. We may see some dollar pullbacks and liquidity grabs into the CPI data or during to retest into this previous accumulation highs around 103.5s or be breaking out higher above 104.5s. That's my main prediction, is that inflation is still elevated, is still going to push the market, signaling rates up higher for longer and fading out some of the rate cut bets, keeping dollar more bullish after a liquidity grab into the previous highs or continuing above 104.4. This translated to gold leads to a liquidity grab into the 2040s or flipping bearish below the 2015s and starting to go into the 1980s. This leads to GBP USD still respecting bearish structure, going back into these lows. Euro USD still respecting bearish structure to go back into these lows or lowers. And UCAD still remaining more bullish on the intraday, being the inverse. This would also lead to a potential short-term correlated bearish pullback phase below the 38,700s to at least be retesting 38K before anticipating further buys again. That's my main bias and prediction, just so you guys know it right off the bat. But let's go through the reasoning behind that, why I see that, what my scenario is, and what our adapted scenarios are. I've already sent the Capital Hungry CPI cheat sheet if you want to check it out and pull it up on your phone or computer now within the main feed and also in Banter. But I'm just going to be copying and pasting it here so we can quickly go through it. Do a quick screen grab. It's faster because there's a bit of animated pictures in here I put in just for people who appreciate visuals a little more. Some woman working her service job and people getting paid more, throwing money around. Understanding recent inflation and market impact. Inflation pressures keep Fed hesitant. Previously, we saw the CPI report increase to 3.4%, indicating a gradual rise in inflation. However, economists anticipate a decrease of 0.5% in CPI for the current reading on Tuesday. They're expecting us to go from the previous 3.4 to a forecasted 2.9, which in my opinion is quite a large ask. It's quite a large drop to expect. The financial markets are eagerly awaiting this month's report. as it could significantly impact speculation on whether interest rates will be cut sooner or further delayed down the line. Whether we're feeding into the stock market greed and having the market price in rate cuts sooner and more rate cuts through the year, or if we're going to be taking away from the stock market greed, pushing back the rate cut hopes, bringing the focus back on rates up higher for longer, which we will be actively observing the Fed funds future positioning during the CPI release. Last month's CPI increase was accompanied by other data indicating possible sustained higher inflation. Both ISM services and manufacturing PMIs expanded, with their price indexes showing significant inflation. January's job data also revealed a 4.5% year-over-year rise in average hourly earnings, aka wage growth, and persistent wage growth could hinder a smooth return of inflation to the 2% target. Now, from then, we've still seen that the services sector has been expanding. ISM prices paid have further increased just with the reports we saw last week. So we're still seeing upside pressure on inflation from the services sector, from non-manufacturing ISM prices paid, and from wage growth. Overall, when we're looking at the energy sector, we haven't seen too much decline or incline when we're looking at energy prices. Natural gas has flattened a little bit, but crude oil has remained elevated at around $70 a barrel. So I don't think the minor drops in energy and disinflation there is enough to singularly impact CPI to bring it down to 2.9%. I still think that there is some pretty significant upside pressure on CPI from what we've seen with the ISM services expansion, ISM prices paid, overall other manufacturing PMI data still being elevated, wage growth throwing the forecast out of the water with the last jobs report, overall labor market still being very healthy when we're looking at JOLTS job opening, unemployment rate. I personally think that inflation is still going to be above 3 to 3.1%. But we have to be careful here when we are looking at when we are going to be looking at the market impact. Okay. Wage growth in the US services sector still expanding can keep upside pressure on CPI in the sticky zone. So CPI. CPI, this is what the cheat sheet's mainly for, is your CPI headline year-over-year data here. Okay. Prior 3.4, whole 2.9, minimum expectations 2.7, maximum expectations 3.3. My exact prediction for this report is 3.2. Still seeing inflation above 3%, not entering the 2% territory yet, still being elevated above the forecast, pushing back some of the rate cut hopes, still showing signs of minor disinflation, but not being nearly as optimistic as the market wants. The market impact from that will be messier. Because you're dropping lower from prior, but still higher than forecast, you have the increased probability of more liquidity grabs and price spikes to accumulate orders from better interest points. And you're not going to see overall as much market movement compared to the data coming out lower than minimum or higher than maximum. But I still think even if we come at a 3.2%, give or take the liquidity grabs, we should still see dollar holding bullish, gold still holding more bearish, and the stock market seeing a controlled, slow grind, bearish correction from the highs. Okay? But these are the scenarios overall because we cannot speak regarding the financial markets in 100% certainty. That's where ego comes into play. That's where traders get married to a bias. And when your bias is wrong, you still keep fighting the technical movement, scaling in on your terrible position. End up crashing accounts, getting emotional, making poor decisions, and so forth. So these are the scenarios that we can adapt to accordingly. Now, if I'm wrong, right, I would prefer to see us see inflation either dropping below 2.9 or being 100% right. I would prefer to see CPI above 3.3 for the main bias. Why do I want to see that? Why do I care? Because the bigger change we have on this report The closer we are to the minimum or exceeding it, the closer we are to the maximum or exceeding it, the bigger the market impact. The more movement we'll see in terms of pips and percentage change on the asset classes we trade. What's that mean for us? More opportunity, cleaner opportunity. So even though my logical prediction is around 3.2%, I would love to see CPI still at 3.3 or higher, because it would really be pushing back some of the rate cut hopes, and it would lead to larger market impact. It would lead to gold having hundreds of pips of movement, dollar having another impulsive leg to the highs, printing new highs, stock market having a bit of a more of aggressive correction from these all-time highs in the example of US 30 that we look at, right? Yes, coming out at 3.2% would still push back some of the rate cut hopes, but it would be more of a mixed sentiment as we're just ranging in between the prior and forecast and in between the minimum and maximum economists and bank expectations there. It wouldn't hold as much market weight. You're probably not going to see continuations into the following daily candle. You're probably going to see a little bit more indecision. Whereas either 3.3% or higher, that's going to hold more market weight. And if I'm wrong, I would rather be 100% completely wrong, and I'd rather see inflation dropping below the forecast, because at least that's going to give us one-sided movement on the opposite side of dollar bears, gold bulls, and US 30 bulls continuing the greed train. Okay, but let's just go through it. February 13th, US CPI year-over-year example. US CPI result 3.3% or higher, which the prior is 3.4, but 3.3 is the maximum expectations. Coming out at 3.3 on the dot or higher shows inflation is still elevated, which pushes back rate cut hopes. This brings the market focus back on rates up higher for longer, more demand in US dollar, less demand in risk assets. This will lead to dollar bulls at either a retest of 103.5 and breakout above 104.5, expecting more market weight and us to break into new intraday highs. This will lead to gold bears after a retest of 2040s, liquidity zone, and fail to break, or holding continued below the 2020s, as we could start to see bearish legs down to the 1980s over the course of days. This would also lead to a controlled US 30 bearish correction below 38,800, as we would see buyers taking profit, short sellers jumping in to provide that exit relief, and a pretty controlled bearish correction to retest lower demand zones at around 38K flat over the course of days and weeks. If inflation comes out at 3 to 3.2%, it still shows inflation is declining from the prior high reading, but missing the mark on forecast. Support signs of disinflation, but not as optimistic as expected. Can lead to more mixed sentiment. Can lead to dollar ranging from 103 to 104.5, gold bouncing around from 2015 to 2025s, US 30 ranging from 38,600s to all the way to the 38,900 all-time highs. Overall, I would see it as a catalyst slowly stacking up to take away some from some of the rate cut bets, but I don't think it would hold as much initial market impact right away. The fully 100%, if I'm 100% wrong, adapted bias is inflation coming out at 2.9% or lower, because 2.9% is right at the forecast, which is already quite a large ask, dropping from 3.4 to 2.9, 0.5% change. Even lower than that, the better for stock market greed of pricing in more rate cut bets. This shows continued disinflation below market expectations or right on market expectations, shows an increased probability Feds will bring a neutral to dovish stance, and markets will price in rate cuts sooner, feeding into stock market greed. This would be us adapting to dollar bears below 103.4, gold bulls above the 2045s and 2050s, and US 30 bulls above new all-time highs at 38,900s. All right. Now, for simple reference on gold here, understanding key prices. If we have the main bias of higher inflation, inflation still sticky and troublesome, I see liquidity grabs in bears or just straight bears below 2015s and 2010s. to go into the 1980s. This is my main bias, my main prediction. Just to put my balls on the line, whether I'll be right or wrong, I always like to have my main bias or prediction, right? The main bias on dollar would look more of the inverse, where we would get a liquidity grab into this potential previous accumulation zone here and continue higher, or just be breaking above 104.5s and continuing higher. And obviously, you correlate this information to your dollar pairs, GBP USD, Euro USD, USD CAD. The adapted bias, if I'm completely 100% wrong, is gold breaking above 2045s, breaking above 2050s, and going back into like the 2070s. This is the adapted bias. The adapted bias of inflation being lower, feeding into stock market greed, removing some demand out of the dollar, markets, because markets are pricing in an increase in rate cut bets, would be dollar trading below 103.2 and 102.6. This is the adapted bias, breaking the intraday bullish structure, breaking below the last NFP prices there, completely fading out the optimistic data, rate cut bets in full force, stock market greed in full force, and trading below those prices. Okay. Obviously, we're going to be doing our live CPI webinar during the New York session tomorrow morning, starting at 8 a.m. Eastern. So we will review some of the key prices we are sitting at by then, some key areas of interest alongside our main bias or adapted bias, and we'll be ready to take advantage. But I just wanted to do that quick review, sharing my research, main bias, predictions, breakdown of CPI, quick little higher time frame review, so you guys all understand what I'm looking for and why I'm looking for it and where I'm looking for it. When is obviously dependent on the data report release and during that morning. Okay. Now, because we don't have too much going on today, it was a slower start to the week. And obviously, the markets are in anticipation for the CPI report tomorrow morning. I am expecting to see dollar ranging overnight, gold probably ranging, not too much significant movement on US equities, gold, or dollar pairs up until the CPI report. Keep that in mind. But now let's do our normal intraday market analysis. Let's check out what we have on the schedule overall through the coming sessions and translate that into trade ideas across these pairs and asset classes that we observe. It even looks like equities may still end up closing below the all-time highs again by the end of the day, but we'll see how that goes. VIX still respecting the support with S&P giving back some gains there, where it looks like we might start to see the breakout tomorrow with higher CPI, US 30 correction, and so forth. But that's just my main bias. Obviously, I'm a nobody. I can be 100% wrong, but we know how to adapt if I'm wrong, which is the good thing. All right, so let's check out the overall schedule. Obviously, CPI is the main important focus point. But let's just see what we got going on through the Asian session, London session, and New York tomorrow. Through the Asian session, corporate goods pricing monthly and yearly, which is a bit of an inflation reading from the corporate sector when you're looking at Japan's economy there, at around 6:50 p.m. Eastern. Both of these figures are still expected to be relatively stagnant and lower. Yearly is expected to see a slight increase, monthly still declined. Overall, if these figures are still stagnant and generally lower from a macro standpoint, all it does is further support Bank of Japan Uchida's comments from last week and shows that Bank of Japan is in no rush to be tweaking their monetary policy yet, that they're still going to be sticking to their stimulus and ultra loose conditions and still going to be continuing their unlimited bond buying program, aka leading to Japanese yen weakness. Even if this is a little slightly elevated, if it's not exceeding the maximum expectations, which is 0.3% here, then we might just see short-lived yen strength for a pullback on GJ before continuing the bulls. I still think these figures will be relatively stagnant with the signals we've been getting from the Bank of Japan last rate decision and Bank of Japan Uchida last week. Then overnight through our London and European trading session, we have some important jobs data for the UK. This is like the non-farm payroll unemployment rate equivalent for the UK though, with your unemployment rate, claim on count, unemployment count change, and unemployment change. Overall, from the signals we've gotten from the Bank of England, UK economy still been resilient so far. Haven't seen policy lag effects of tighter financial conditions weigh negatively on the UK economy yet. That still looks to be deeper into 2024. So I'm still expecting neutral to healthy data here with the UK jobs. This can give GBP/USD a short-term bullish pullback against a stronger dollar and can also just further support our GJ bullish bias. If data is poor short-term, I think it's just going to be a short-term bearish pullback on GJ before continuing better buys after retesting a lower demanded price point. And it will just further support GU bearish bias, which I think GU will be bearish due to dollar strength anyways, especially if we have elevated CPI tomorrow. Then we just got some economic sentiment and economic conditions reading from Germany, expecting very slight rebound on economic sentiment. Current conditions still poor. I still think euro is bearish, especially against the stronger dollar. And then at 8:30, our CPI reading, with the main important being the CPI monthly change and CPI headline year over year. Core, some people do look at core. I look at it for just overall data research, not as much in terms of market impact. The headline data always takes center stage there. So this is going to be the more important one. From a central banking and political perspective, nothing too crazy going on overnight or tomorrow. Now, keep in mind, expecting gold, dollar pairs, US equities to be ranging a bit more up until CPI, but I am still more on a bearish bias on gold to be retesting lower demand zones. From the supply zone in that higher time frame 2080s being respected, the supply zone at 2060s being respected, starting to create stronger intraday bearish market structure here, resistance level at 2040s. The last make or break area, depending on the data tomorrow, is really just at the 2010s to 2015s. Overall, when I'm looking at gold, even into price positioning for CPI, if we break above 2028, I would see short-term price squeezes, short-term bulls to retest into the 2040s before looking for better sells down to the lower prices. Otherwise, I'm looking for breaks below 2010s and breaks below 2005, sell still. Middle Eastern tensions and premium priced in, no major fear, uncertainty, or doubt. Buyers' exhaustion from these higher time frame prices. If we have this liquidity grab, I would be scaling sales back down. Breaks below 2010, breaks below 2005s. Only see short-term bulls above 2028 to be retesting into the better sell zone. GBP/JPY, I am still bullish fundamentally and technically. We just have to watch this last resistance point being the last higher time frame highs. I would see short-term pullback phases below 188.2 to retest 187.5 before continuing some of the bulls. This is a very key price point we were talking about. Outside of the PPLs and key levels, where we broke back above that price sensitivity area, where we were seeing a short-lived pullback below or even respect to there previously. Overall, still respecting bullish structure as we just retested previous highs with the Bank of England sentiment still keeping us bullish here. And I like this bullish market structure starting to form for retest into the 187.5s or continuations higher, as we're still following that higher time frame market structure and interest rate differential. Short-term pullback below 188.2s to retest 187.5 buys. Break out above the current high, continuation buys. GBP USD, I'm still in a bearish bias ever since we had the neutral to hawkish tone FOMC and then the extremely optimistic jobs data pushing back some of the rate cut hopes. Would still be looking for a retest of 1.266 cells, break below 260 cells, break below 256 cells. Would only be adapting to a bullish bias if our sell areas are completely invalidated, dollar turns bearish, CPI is much lower than expected, with breaks above 26927, which I would anticipate still being short-lived to retest that higher time frame supply zone we've been identifying at 1.28 flat. My main bias and expectations is this type of price movement, though, with these three key areas of interest. Euro USD is similar. I would still even be bearish at a retest of 1.083, fade out back below 1.079, break below 1.076. Potential CPI liquidity grabs before fading it and continuing lower. Only adapting to a bullish bias with a shift out of bearish structure and breaks above 1.087, or depending on what prices we are sitting at tomorrow during the CPI release. If CPI is completely against my prediction and much lower than expected, feeding into rate cut bets and dollar weakness. USD CAD, I'm still bullish and still see us driving up to this key liquidity zone and supply zone at 3.6 before anticipating sells again. I would still be looking for a sweep of 1.34 buys, break above 348 buys, break above 355 buys. Would be looking for sells back into that key liquidity zone and supply zone from a technical perspective after the moves have been priced in at 1.36. US 30 at a key make or break area here, where if we start to get dollar demand coming back into the scene, higher than expected inflation, don't print any new all-time highs. I would see short-term bearish correction plays, buyers taking profit, rate cut bets being pushed back to retest all the way to 38K or 37,800 before anticipating buys again. Otherwise, only see any continuation buys if we can be trading above 38,900, breaking out into new all-time highs, which I need a fundamental catalyst to support more rate cut bets coming to the scene, which would only be inflation lower than forecast or right on forecast. All right, everybody. I don't want to be rambling and yapping too long, but hopefully that was a very educational and informative webinar for you guys, going through a bit of higher time frame review, key prices review, fundamental and technical analysis, CPI preparations, CPI scenarios, my main bias and predictions, some of the key economic events we have on the schedule, some of the intraday analysis and trade ideas going into tomorrow. Please remain very adaptive to the CPI report. You got the cheat sheet, and let's be following our trading plans, assessing our risk, and whether our prediction is right or wrong, making sure we can still grab a nice high probability piece of the pie, grab some crumbs out of the pie, make our money, and live to trade another day. If anybody has any questions, comments, concerns, or issues, please let me know now. If you got problems, questions, compliments, hatred, trolls, jokes, anything, let me know now. Otherwise, I'm going to save and upload this, and I'll see all of you tomorrow morning. Okay.